very quickly. Foreign exchange risks, you've got three types of risks: economic risks, transaction risk, and translation risk. Economic risk, these are long-term fluctuations. And we are not going to discuss this a lot. It's not our concern. Like within any economy, when there is a long-term fluctuations of currencies, that some currency is continuously kind of losing power, it is becoming weaker and weaker. So that is the risk which is on the environment overall, and that is which is related to long-term fluctuations. We just skip it for a moment. This is not our focus of attention. Transaction risk, this is your everyday, you face it every day. Whenever you receive an invoice in foreign currency, and remember that it affects your cash. This is the thing which we are interested in. So this is the thing we are interested in: transaction risk. Transaction risk means that you receive an invoice in dollars, your local currency is something else, probably your local currency is euro, or your local currency is AED, Emirates dirham, whatever. So this is the risk which accountants they face every day, every time you receive an invoice, because what you're going to do, you are going to book it in your own currency, and then ultimately you have to pay it in a foreign currency. So this is what we are going to discuss. Now remember that you have two types of currencies. You call it your functional currency, and you call it your presentation currency. Functional currency, we say that this is the currency. Okay, let me put it down here. Functional currency is the currency of your primary environment, primary business environment, in which you pay your expenses, price your products or services, or decision making is done. So this is your functional currency. Functional currency is that currency in which you do your everyday transaction, like your salaries you pay. For example, if you are in UAE, so you pay your salaries in dirhams, you pay your operating expenses in dirhams, all your payments are in dirhams, and you sell your goods in dirhams. You price your products in dirhams. So dirham is your functional currency. And this is the currency in which you should be entering your data. Your accounting system is operating in dirhams. So all your invoices you are entering in dirhams. So this is called functional currency. Presentation currency could be anyone. Presentation currency means that end of the year, you present your financial statements in some currency. For example, it is possible that you are working in UAE, your functional currency is in dirham, but when you do reporting for head office, you do it in USDs, because your shareholders sitting in head office, they want USDs because they have their own investments in USDs, they have liabilities in USD, they think in USDs because they have been using USDs. So presentation currency, you can decide anything. Like you are a company in UAE, your functional currency would be dirham, but presentation currency, you say, maybe I make it in Japanese yen. Maybe you decided to make it in Indian rupee. Maybe you decide to make it in euros, anything. So for presentation currency, there is no restriction at all, but functional currency has to be the currency of the primary environment. Am I clear until here?
Yes, sir.
Okay. So transaction risk, I go back to the risk. Economic risks, I'm not focusing for F7. Transaction risk, yes, this is the thing which we will do in exam questions, and this is what happens. Like every day you face this one. Translation risks, it is just a conversion from functional to presentation currency at the end of the year. So it's on paper and no cash impact. What do I mean by that? You prepare your income statement and your balance sheet in dirhams. Then end of the year, on 31st of December, you make your income statement in dirham, you make your balance sheet in dirham. And then because you have to present it in USDs, so you convert all the dirham values into USDs. So it is not going to give any cash impact because you are not receiving cash, you are not paying cash, you are just converting or multiplying the numbers from one currency to another currency. You may have some exchange gains or losses while this conversion, but it will not give you any cash impact. What do I mean by cash impact? And by the way, we will only be focusing on transaction risks more because this is the topic which comes in exam more. And let me show you that how transaction risk it works. Let's suppose that I say that you receive an invoice for USD 1000 payable in 30 days. So you receive an invoice on 01/01/2010 for $1,000. You have to pay it in 30 days. And then they tell you that on 01/01/2010, 1 USD is equal to 3.5 AED. So the conversion, the exchange rate, the exchange conversion is 1 USD is equal to 3.5 dirhams at that particular date. Now, kindly give me just 1 minute. I just need to write one message. Give me 1 minute, please. So you receive this invoice, and the date when you receive the invoice. So on 01/01/2010, when you receive the invoice, your exchange rate is 1 USD to 3.5 AED. So you will say, debit purchases, credit payables, and you will record it 3,500 here and 3,500 here, because on that particular date, 1 USD is 3.5 AED. So you convert 1,000 USDs multiplied with 3.5. So this is what you record as your liability, and this is what you record as your purchases. Now what happens that on 31st of January 2010, the rate fluctuates. Now you've got here 1 USD is equal to 3.7 AED. So can you tell me, AED is becoming stronger or is it becoming weaker?
It's becoming weaker.
AED becoming weaker. So you have to pay $1,000. You have to pay 1,000 USDs because your invoice is in USDs. So now you need 3,700 AED to settle off your liability. You need 3,700 AED to settle the liability. Previously, you thought that you would pay 3,500 AED. Now you have to pay 3,700 AED. So what you do, you have to settle your liability. You will say debit payable, and your payable was 3,500. But when you go to the bank and you started conversion from the bank, so your bank or cash, which will be credit, bank will take 3,700 from you. So there is like $200 difference, and that is 200 is a loss. It is an expense. You can debit, foreign exchange gain or loss, which you call forex gain or loss, forex. And how much is that? That is 200. So you made a loss of 200. So that's why I said that it has a cash impact. Transaction risk, they have a cash impact because you lost cash. Now, there could be another situation that let's suppose that on this particular day, for example, when you come down on 31st, the rate is like 3.2. Let's suppose that it goes like this. So if the rate is 3.2, then you need to have, you need to settle, you can settle the liability with only 3,200. So your bank will have 3,200 credit, but you are settling a liability of 3,500 while paying just 3,200. So then you would have made here credit this one, credit, foreign exchange gain loss, and 300 you would have made the gain. So foreign exchange transactions, when you receive the invoice and when you pay the invoice, on these two different dates, there is always, a change in the exchange rate, and that change in the exchange rate would cause you to pay less or to pay more in the local currency, and those are your exchange gains and losses, which you take to other comprehensive income. Am I clear?
Yes, sir. So meaning, and the gain, we take it to other comprehensive income, not the P&L.
What happens? Actually, what happens? You put it in OCI as long as they are unrealized. As long as they're unrealized. What do I mean by unrealized? Let's suppose that we purchase these goods on, let's suppose on 15th of December 2010, and we have to pay it on 15th of January. But then on 31st of December 2010, this happens. So on 31st of December, I'm not paying in cash. I'm not paying yet, but I have to restate my liability. So this is actually, if this is happening on 31st December, I'm not paying, but I'm just calculating that what is my liability as of today. So my liability as of today is 3,700, for example. So in that case, it is called unrealized gain because you have not paid it yet. It goes into OCI. But if you are making payment, actually, the payment date has come in and you actually make payment. So in that case, it is realized loss. Then it goes to P&L.
Okay.
Like if you are making payment and you are making a gain or loss, so it means it is realized, it goes to P&L. But if it is something which you are not paying on 31st of December, you are just measuring that what will happen to my liability, because liabilities you have to restate. Like you've got a liability of a million USD. A million USD liability you have. So let me explain you. When you got it, it was 3.5. So you record your liability as 3.5 million. So this is what you what you suppose. This was 1 million USDs, okay? And your currency, your conversion rate is 3.5 on this date. Let's suppose on 31st of December 2010, when the invoice was issued. So you book your liability with 3.5 million AED. But then what happens? Okay, this is actually, let's call it 15th of December. But then on 31st of December 2010, you are not paying. You have to pay here on 15th of January 2010. But on 31st of December, you are closing your books. And you know that this still remains your liability. But on this date, it is 3.7. So it means that your liability in terms of dirhams it has increased. So whatever is the difference, this thing minus this things, that $200,000, it is your loss it is your forex loss. and it will go to OCI. Why OCI? Because I'm not paying here. I'm just recalculating it, how much it will be. But then on 15th of January, you still have your invoice is still this one, but the actual rate comes out to be 3.6. So if it comes out to be 3.6, you have to pay this much, 100,000. So your realized loss is just 100,000. Okay. So you reverse some portion of this previous one, and this you take it to P&L. They will not ask you to show how to take it in P&L. They will only ask you how to calculate it. Now, are we clear on that?
Yes, sir.
Yes.
Okay. I'll do one question. I will not let you go like this. I will.
Sir, I want to ask one question because it's like this topic I read it before.
Yeah.
But I was intended to do a quick revision. They said something about monetary and non-monetary items.
I'm coming there. I'm coming.
Okay.
There. So this was transaction risk. The second one, which you have here, the third one, which you call transaction risk. Okay. Translation risk. This thing, translation risk. What is that? As I told you that it is just a conversion at the end of the year. So translation risk means that come 31st December, you've got your AD. So end of the year, let me write down. You have your financial statements, which you must translate into USDs. So you are not going to make payment to anyone. You are just translating it from one language to another language. Language means from one currency to another currency. We call it translation. The rule is that you have balance, you have income statement, and you've got balance sheet. Okay, let me first tell you something else. What they give you in exam, they will tell you that on 01/01/2010, then on 15th, of I don't know, let's call it 15th of June 2010, then they give you 31st December 2010, then they give you average. So what is that? Okay, this is, I will take out this one for a moment. I'll explain you this later. Here, your rate was 1 USD is equal to 3.5 AED. And on 31st of December, it is 3.7. And on average, it was 3.6, 3.55. Okay, let's call it like this. So they give you different rates during the year. The rate in the beginning of the year, the rate at the end of the year, and the average rate. The average rate.
Mm-hmm.
May give you another rate here as well. May give you that on 1st of June, probably here, and that rate was 3.64. Let's suppose. Why do they give us these different rates? When do we use them? So the rule is that income statement, since all revenues and expenses accrue throughout the year, therefore use average rate. So income statement, when you have to translate, income statement, you have numbers like revenues and cost of sales and gross profit. You translate all of them with average rate. Average rate was 3.55. Okay, clear? It makes sense.
Yes, sir. Yes, sir.
Because income statement revenues, they did not appear on one particular date. They accrue throughout the year, and throughout the year, your average rate is 3.55. So you multiply your revenue with 3.55 or divide it. Yeah, you are dividing because you are showing it in AD. Your income statement has 1 million dirhams, divide with 3.55. 600,000 cost of sale divided with 3.55. So everything divided by 3.55, and you convert it into USD. Clear?
Yes, sir.
On balance sheet, you have monetary items and non-monetary items. So monetary items which are related to cash, which are going to be monetized, where you receive or pay cash. Monetary items, you have receivables, you've got payables, you've got inventories, your other current assets, and your other current liabilities. Any type of current item, current asset, current liability. These are your monetary items. And non-monetary items are your non-current assets. So non-current assets, what you will use historical rate. Historical rate means the rate when this asset was purchased. And that's why they may give you this thing, This may be a historical rate. Historical rate means that a rate on a particular date. They will tell you that the business purchased a non-current asset for $1 million on 1st of June. So what was the rate on 1st of June? You will apply that rate. What was the rate on 1st of June? 1st of June rate was 3.64. So your non-current asset will be translated at the historical rate. It makes sense. It makes perfect logic. Yes or no?
No. Why is it a historical rate?
Historical rate means the rate when it was purchased. Like, when did you purchase the asset? You say, I purchased asset on, 1st of June. So what was the rate on 1st of June?
Oh, okay.
So it was 3.64, the asset value. So you purchase asset for, 100,000 USD. When did you buy it? You purchased it on 01/01/2010. And what was the rate on that date? 3.64. So you say that this asset in your balance sheet is like, 364,000 dirhams. Okay, it is on historical rate. Then your monetary items, receivable, payable, this you mention on closing rate. Closing rate, which means end of the year. What is the closing rate? Closing rate is 3.7, because liabilities or receivables, you have receivable and payable on 31st of December. So whatever is the rate of 31st December, that is the value of your liability. For example, you've got $1 million, you've got $1,000 liability. Your liability is $1,000 in our previous example. So when we got the invoice, at that date, when you receive invoice, you have 1 USD equals to 3.5 AED. So you book your liability as 3,500 AED. But then, end of the year, you already have got 1 USD is equal to 3.7 AED. So your liability will be 3,700 AED. You cannot say that my liability is 3,500. End of the year, you have not paid the invoice. Invoice is still with you. Invoice is $1,000. So how many AEDs do you need on 31st of December when you are making balance sheet? So on the balance sheet date, this 1,000 USD means that you have a liability of 3,700 AED. So that also makes perfect sense. Clear?
Yes, sir.
Yes, sir.
Yes or no?
Yes.
Clear, sir.
Okay. Let me show you a question now. Let me send you a question. Do you guys have WhatsApp?
Yes, sir.
Of course.
Okay. I'm sending it to Emmanuel and Nukutla. Did you receive something?
Yes.
What did you receive?
Question 237.
237. Please read the question.
Mr. by
That you have an invoice, which is for how much amount?
50,000
50,000.
You have 50,000 euros. It is euros 50,000 euro invoice, payable in 2 parts.
Yes.
25,000 euros each. When you receive it, you book it at current rate. And your current rate was how much? 1.63, right?
16.
It was 1.63. So when you book it on, you receive it on, 1st of November. So on 01, whatever is the date, let's call it 2009, I don't know. You make your liability at opening rate, and you've got here euros invoice, and you've got here dollars where you book. And your rate between dollar and euro was 1.63. So euros are 50,000, and it will make you, how many USDs? It will make you 30,674 or 75 USDs. This is your liability. This is your books, okay? Your
The
book.
date should be 2008, sir.
Sorry? I just put it any date, doesn't matter. Then what will happen? So it was actually 0111, 1st November. Then
Yes.
1st of November, 2008, the rate has changed. On this particular date, the rate is 1.61. You have to pay euros. You don't have to pay dollars. This is your total liability. You are not going to pay half of this. You have to pay half of this because you pay 25,000 euros. And 25,000 euros, how much it makes? So actually, if I see it here, that 25,000 euros, if I convert them to 1.61, so I am paying 15,527 or 15,528. Do you understand? Please pay attention. Your liability is 30,675 USD, but you don't pay 30,675 half of this. You are not paying half of this. You have to pay half of this, half of your invoice, because you are not making payment in dollars. You are making payment in euros. So you pay 25,000 euros. 25,000 euros, it takes this much, 15,528. So you book it here, like this much. So this is what is gone from you, 15,528. But how much is the loss? How much is the loss? How do you calculate the loss? You know how do
We
I calculate the loss?
we can take the initial value divided by 2.
Yeah, this one divided by 2 and this one.
Yes.
This is my loss. I mean,
Can you explain that again?
yeah, because see here, for making 25,000 euros, you took from your bank 15,528, right? This is what you are making. Okay, let me make a separate column. I will say here payment. But according to your own books, half of this you should have paid. You should have paid. So this is what you should have paid actually. I mean, in your books, your liability was 3675, but you are paying, of course, in euros. So 3675, half of that is 15,337. But you actually paid it on a new rate. You paid 13,528. No?
Yes, sir.
No. You explain me.
Okay.
Pamela?
I understand now.
Okay,
Yes,
I'll
sir.
explain it again. I'll explain it again, Pamela. I'll remove these numbers. I have liability of 50,000 euros, which when I received the invoice, I converted it with 1.63. It made me 30,675. Okay. Then after 1 month, I have to pay euros. And I say that 25,000 euros I have to pay. So how much I have to pay? It will be based on this rate. So I would say 25,000 euros divided by 1.61.
1.61.
This is what I'm actually paying, right? But how much I should have paid? I should have paid this half of this one because my total liability was 3675. So if I divide this number with half, I should have paid 15,337, but I am paying 15,528. Right?
Yes, sir.
So it means that I am paying more. So whatever is the difference, that 191 is going to be my exchange loss because I'm paying more in local currency. Then comes 31st of December 2008. Again, I have to pay 25,000. And on this date, the rate is 1.64. So when I go to the bank, I say, I want to make a payment of 25,000 euros. The bank will convert it. And the bank will say that, this amount divided by this amount, you have to pay $15,244. So this is what actually I'm paying. But how much I should have paid then? How much
15337.
I should have paid this much divided by this much. So this is what I should have paid according to my books. But this is what the bank is taking from me. And this time I'm paying less. Because according to my books, I should have been paying 15,337, but I'm just paying 15,244. So I am making a forex gain. So these numbers I'm taking from my actual, what initial it was, initial liability. This is what is at the date of payment. And the difference is my forex gain or loss. Got it?
Yes, sir.
Yes, sir.
Okay, so maybe I'm going to upload this very soon. I will be uploading it in 1 hour. But this is one typical question which you may receive in exam. Amila is not yet clear. Amila, this is your liability in euros. This is your liability in USDs, right? When you purchased it. They ask you to make payment of two payments, 1 month each month. So you will say that, you have to make payments on 2 dates. One you have to make on 31st of November 2008. Another payment will be 31st of December 2008. And how you are going to pay? Your supplier has given you 50,000 euros invoice. So you have to pay 25,000 euros here, 25,000 euros here. This is what you agreed with supplier. When you book it in your books, when you record it in your books, on that date, the invoice value was 1.63. So you thought that your liability is 30,675 USDs. So how much you have to pay in USDs? In your books, this is what you expect to pay. You say that I will make 2 payments in USDs like this, right? Is it clear?
Yes, sir.
But in reality, what happened? That on this date, the rate was this one, and here the rate was 1.64. When you went to the bank and you said to the bank, see, I want to pay 25,000 euros, and bank will convert with this rate, and bank will say you that, okay, you want to pay 25,000 euros, you should give me 15,528 USDs. Now, you thought that you would pay 15,337 USDs, but bank is asking you to give 15,528 USDs. So you are paying more USDs as according to your books. According to your books, you should be paying 2 installments, this 3675 in 2 parts, which is $15,337, $15,337. But you cannot pay in dollars. You have to pay in euros. So you go to the bank, you say, I need 25,000 euros. And bank will give you 25,000 euros for 15,528 USD. So you have to pay a little bit more than your expectation. And how much? You have to pay 191 more. And that is because of this conversion. Then 1 month later, you again went to the bank and you said, I want to make 25,000 euros more payment. How many USD should I give you? And the bank will say that you have to pay 15,244 USDs. You are happy this time because you thought that 25,000 USD means 15,337, but they actually came out to be 224. So here you get a positive number. This is your loss. This is your gain. Clear?
Yes, sir.
Okay. So that is all about this one. Now let me, how to say, give me 5 minutes. So this is a very short chapter, limitations of financial statements and interpretation techniques. So here we talk about what are the limitations of financial statements. I'll go quick because I'm not going to discuss it in a lot of detail. It's not something which is very, very, very important, but you may get a 2, 3, 4 marks objective type question here, okay? So limitations of financial statements, problems were with of historical. So you know that financial statements, they provide you historical information. One thing I must tell you that before I start this chapter, let me just tell you that the financial statements which you prepare them on historical data. You prepare that on, what happened in past. And they tell you when you interpret it, you only interpret your past. It does not give you a very sound basis for future. What do I mean by that? Like if you see the income statement, it says that you've got a profit of $1 million. So if you made a profit of $1 million in 2019, will you make 1 million in 2020 as well? That is very hard to predict. Your financial statements, these are called financial analysis, financial interpretation, and this is called your financial performance. Your financial performance only tells you about your past. It does not speak a lot about future. If you want to know about your future, you have to see non-financial indicators. In your business, you've got financial performance indicators, which are your ratio analysis and numbers from income statement, balance sheet, and you've got non-financial performance indicators. For example, I tell you that you made a $1 million profit